Working as an accountant in the UK for over 10 years, I've noticed one thing. A lot of people are paying more tax than they actually need to. Not because they're doing anything wrong, but because nobody ever explained how tax works in simple terms, or showed them where to look and what to do. So in this video, I will share 6 simple ways you can pay less tax in the UK, even if you know nothing about tax. Let's get into it. Most people think pensions are just about retirement, but here is what most people don't realize. Pensions are one of the most effective ways to reduce the amount of tax you pay. Because your pension contributions are deducted from your gross income before tax is calculated, so the more you put in, the less tax you pay. Let me show you a simple example. Say your monthly gross salary is £3,000, so you are a basic rate taxpayer. If you don't contribute anything to your pension, your income tax is 20% of £3,000, that's £600 per month, and your take-home pay is £2,400. Now you decide to contribute 10% of your salary into your pension, that's £300 per month. This £300 comes out before tax is calculated, so your taxable income drops to £2,700. Income tax is now £540. That's a tax saving of £60 every month. Your take-home pay is now £2,160. That's £240 less than before. But remember, £300 has gone into your pension. In total, you have £2,160 in your pocket, plus £300 in your pension. That's £2,460 in total, which is actually £60 more than if you made no pension contribution, or because you paid less tax. And if you are a higher rate taxpayer, the saving is even bigger, because every pound you put in saves you 40p in tax, not 20p. There is another tax advantage that many people don't realize. The money inside your pension doesn't just sit there. It gets invested and grows over time. And that growth completely tax-free. No capital gains tax, no dividend tax. So you are not just saving tax today. Your pension pot is growing tax-free in the background every single year, allowing your investments to compound over time without tax eating into your returns. One last thing I'd like to mention here is carry forward. In the UK, you can contribute up to £60,000 into a pension each tax year and still get tax relief. That's your annual allowance. But let's say this year is unusual. Maybe you've received a large bonus, maybe you completed a big project. If you didn't use all of your pension allowance in the previous 3 tax years, you may be able to bring some of that unused allowance forward and contribute more this year. I won't go into all the details here, but if that sounds like your situation, it's definitely worth looking into. Now, speaking of pensions, there is another tax-saving strategy that many people overlook. It's called salary sacrifice. The idea is simple. You agree to give up part of your salary, and in return, your employer provides a benefit instead. Because your taxable salary is lower, you pay less income tax and less national insurance too. It can be used for a range of benefits, including workplace pensions, cycle-to-work schemes, electric vehicle schemes, and some childcare schemes. In fact, if your pension is set up through salary sacrifice, you'd save even more than the example I just showed you. Because you'd also be saving on national insurance on top of the income tax saving. Let me show you how this works with a simple example. Say your monthly gross salary is £3,000. You want a new bike that costs £1,000. In real life, cycle to work is usually spread over several months, but to keep things simple, let's say the full £1,000 is sacrificed in 1 month. Option 1. You buy it yourself, out of your take-home pay. Your full £3,000 salary is taxable. Income tax at 20% is £600. National insurance at 8% is £240. Take-home pay is £2,160. You then spend £1,000 of that on the bike, Money left in your pocket is £1,160. Option 2. You get it through cycle to work salary sacrifice scheme. That £1,000 comes out of your salary before tax. Your tax and national insurance both drop, and your take-home pay is now £1,440. Plus, you already have your bike paid through the scheme, so you don't need to spend anything now. Money in your pocket is £1,440, same bike but through the scheme. You end up with £280 more in your pocket. And if you are a higher rate taxpayer at 40%, the savings are even bigger. So before paying for something out of your own pocket, it's worth checking whether your employer offers it through salary sacrifice. If you are not sure, ask your HR team or check your employee benefits portal. Now, this next one is specifically for married couples and civil partners, and it's one of the most overlooked tax breaks in the UK. It's called marriage allowance, and it could save you £252 every year, just by making a simple application. Let me show you a simple example. Meet James and Emma. They are married. James earns £35,000 a year. Emma works part-time and earns £8,000 a year. Now remember, most people in the UK can earn up to £12,570 before paying income tax. This is called the personal allowance. So let's work out James' tax bill. His income is £35,000. After taking away his personal allowance, he's left with taxable income of £22,430. As a basic rate taxpayer, he pays tax at 20%. That gives him an annual income tax bill of £4,486. As Emma only earns £8,000, she's not using all of her personal allowance. She has £4,570 sitting unused. And this is where marriage allowance comes in. Emma can transfer £1,260 of her unused allowance to James. That's the maximum amount the rules allow. After the transfer, James now has a higher effective allowance, £12,570 plus £1,260. That's £13,830. So his taxable income drops to £21,170. Income tax at 20% on that amount comes to £4,234. That's a saving of £252 a year. James takes home £252 more every year just because Emma transferred part of her unused allowance to him. And Emma, she still has over £3,300 of unused allowance left. She is not losing anything. One important thing to know, marriage allowance generally only works if the person receiving the allowance is a basic rate taxpayer. So if the higher earning partner pays 40% tax, this generally won't apply. Now, here is the part most people miss. You have to apply for this yourself. HMRC will not do it automatically. The good news is you only need to do it once. Once applied, the allowance transfers automatically every year until you cancel it. And you can backdate your claim up to 4 years. So if you've been eligible since 2022 and never applied, you could claim back over £1,000 in one go. So if you are married or in a civil partnership, spend 10 minutes checking. You could be missing out on money you are entitled to. Now, this next strategy is particularly useful if you are married or in a civil partnership and have savings or investments. Most couples never think about whose name their savings or investments are in, but it can actually make a significant difference to how much tax you pay. Here is why. In the UK, investment income such as dividends and the savings interest are generally taxed based on who owns the asset. And the higher rate taxpayers usually pay more tax on that income than basic rate taxpayers. You can see the difference on screen here, especially with dividends, 35.75% versus 10.75%. That gap is exactly where the tax saving comes from. Let's bring James and Emma back for another example. James earns £60,000 a year, so he's a high-rate taxpayer. Emma earns £20,000 a year, so she's a basic rate taxpayer. Now let's say they have an investment portfolio generating £10,000 of dividends every year. Let's look at two different scenarios. Scenario 1. All investments in James' name. James pays dividend tax at 35.75%. On £10,000 of dividends, that's £3,575 in tax. Scenario 2. All investments in Emma's name. Emma pays dividend tax at 10.75%. On the same £10,000 of dividends, that's only £1,075 in tax. Same investment, same dividends, but £2,500 less in tax, just by having the investments in Emma's name instead of James. The same idea applies to savings interest too. If James holds the savings in his name, the interest is taxed at 40%. If Emma holds them instead, it's taxed at just 20%. Now, you might be thinking, what if the investments are already in James' name? Can we still move them? Yes. And here is something most people don't know. When you transfer investments between spouses, you normally don't pay capital gains tax on the transfer. So you can move existing assets across without triggering a tax bill. Just make sure the transfer is genuine. The assets need to actually belong to Emma, not just on paper. And this strategy only applies to married couples and civil partners. If you are not married, the rules are different, so it's worth taking advice before making any transfers. Now, whether you are investing in your own name or your spouse's, there is one place that can make things even more tax efficient, and that's our next strategy, ISAs. ISA stands for Individual Savings Account, and for many people, it's one of the simplest ways to reduce tax legally in the UK. Here is why. Normally, when your savings generate interest or your investments generate dividends or capital gains, you may have to pay tax on that income. But inside an ISA, those gains are completely tax-free. No dividend tax, no capital gains tax, and no tax on interest. In other words, once your money is inside an ISA, HMRC can't touch those investment gains. For the current tax year, you can put up to £20,000 into ISAs, and if you are married, that's potentially £40,000 per year between the two of you. The best part? Unlike a pension, your money isn't locked away until retirement. You can access it whenever you need it. I've already made a separate video explaining exactly how ISAs work, the different types available, and how to use them effectively. So, if you'd like a full breakdown, make sure to check that video out after this one. Now, our final way is specifically for parents, and it's one that many families are missing out completely. It's called tax-free childcare. And I actually use this scheme myself for my son's after-school clubs. It's made a real difference to our monthly costs. Here is how it works. The government gives you an online account just for paying childcare costs. Every time you put money in, the government tops it up. For every £8 you put in, the government adds £2. That's a 25% top up on everything you pay for childcare. Nursery fees, after-school clubs, holiday camps. And here's a tip. If you are already paying for sports clubs, activity clubs, holiday camps, or even some tuition centers, don't assume they won't qualify. Ask the provider whether they accept tax-free childcare. You might be surprised. The maximum the government will add is £500 every 3 months. That's £2,000 per child per year. If your child has a disability, that goes up to £4,000 a year. Who's eligible? Generally, both parents need to be working. Each parent needs to earn less than £100,000 a year. Your child must be under 12. That's it. It's that simple. Now, here's something worth knowing. A lot of parents assume they don't qualify because one of them earns over £100,000, but that £100,000 limit is based on your adjusted net income, which is your income after pension contributions. So it's worth double-checking before you assume you are not eligible. And this is very different from child benefit. Child benefit starts getting reduced once one parent earns over £60,000. Tax-free childcare has a much higher limit, and both parents are assessed individually, not as a household. So even if one of you earns significantly more than the other, you could still qualify. If you have children in childcare and you are not using this yet, set it up today. It's on the government's website, takes about 20 minutes, and the savings are real. For every £800 you spend, the government adds £200, up to £2,000 per child every year. If you are eligible and not using it, you are leaving free money on the table. So those are 6 legal ways to pay less tax in the UK. The important thing to remember is this. Most people don't pay too much tax because they are doing something wrong. They pay too much tax because they simply don't know what they are entitled to. Even using just one or two of the strategies we've talked about today could save you hundreds or even thousands of pounds every year. So take a few minutes after this video and see which ones apply to you. And if you'd like me to do a deeper dive into any of these topics, let me know in the comments below. And if you found this helpful, make sure to like the video and subscribe to the channel. Thanks for watching, and I will see you in the next one.